Bank collapses are terrifying. There's no way around that. The thought of waking up and having your checking, savings, or investment accounts just disappeared into the ether is enough to keep anyone up at night. Hey guys, what's going on? My name is Robert Montez. I am a financial advisor with Link Financial Advisory, where we are focused on helping you win with money. Today we are going to be discussing what happened with Silicon Valley Bank. If you've been paying any attention, you saw that there was a bank failure. We're going to go into what caused that bank failure, 3 questions we should be asking now as the consumers moving forward, and what we as a firm do to protect our client from this type of risk. Let's go into the first subject, is what are the reasons that Silicon Valley Bank failed? Well, there were 3 main reasons. Those reasons are: 1, what they chose to do with their deposits as far as how they were investing it; 2, their client base was not very diversified; and 3, they had the majority of their accounts exceeding balances that were covered by FDIC insurance. Let's start with each one of those and break them down. Number 1, how they chose to invest their money. If we look back to 2020, in 2020, tech industries were doing great. Interest rates were at historic lows due to the government doing everything they could to keep our economy strong. And so there was a lot of cheap money running around our economy. Well, for startup companies, especially in the tech industry, that was great. That meant that they could reinvest in their business, grow at a strong pace, and deposits were up at Silicon Valley Bank as a whole because their specialty was small startup companies. Well, when these deposits were coming in 2020, Silicon Valley Bank had to figure out, what do we do with this money? They chose to invest that money into treasury bonds, which are loans to the federal government, which historically are safe investments. However, Silicon Valley Bank elected to put these into treasury bonds that had long maturities. What that means is these bonds weren't set to mature for years and years into the future. The problem with that is these bonds are also the most at risk to sudden changes with interest rates. Well, anyone who looks at what's happened since 2020 to 2023 knows that interest rates have skyrocketed. Inflation got crazy. The Fed is doing everything they can to slow the economy down, and a lot of that has to do with raising rates. What does that mean for a bank like Silicon Valley Bank? Well, their client base in the tech industry, tech has slowed down tremendously, so that's not nearly as profitable. Here in 2023, deposits have slowed down, so no new money is going into the bank. And the bonds that they bought back in 2020 were trading at a deep discount from what they bought what they paid for them back in 2020. So these bonds, when interest rates go up, the price of bonds go down. And ultimately what that led to is that Silicon Valley Bank was just in a position where their credit rating was getting ready to go down. The week of March 6th, Moody's called them. Moody's is a credit rating agency, told them, hey, your credit rating is about to be decreased. Silicon Valley Bank, as a result, tried to get ahead of that. They tried to sell off the bonds they hold, and that was going to be at about a $1.8 billion loss. They were then in turn going to try and re-raise the capital to buy new bonds, keep them from having their credit rating decrease, and just kind of move on. Well, they tried it. They got halfway through it. They were able to sell the bonds. They lost, like I said, about $1.8 billion, but they could not raise the capital to buy the new bonds that they were after. As wind got out of what was going on the week, I believe Wednesday, the week of the 6th, so it's the 9th, I believe, people started to see what was going on. Venture capitalists started to see there were some cash flow issues and started to panic. And as a result, they started to pull their money out very fastly. That Thursday, there was a $42 billion bank run where people were trying to pull their assets out any way possible. Obviously, that's not sustainable as a bank, and by Friday, the FDIC was involved. So number 1 issue was, again, they invested into bonds that had long-term maturities that were very subject to interest rate changes. Issue number 2 was their client base. We kind of discussed this a little bit earlier, but Silicon Valley Bank's client base was a lot of small startups. And we all think small like mom and pop, but no, there's real money in these tech startups. Well, what happened there is that because tech was getting hit at the same time as all the stuff with the interest rates, just like we were talking about earlier, the industry as a whole slowed down. So they had a large pool of their clients suffering at the same time as they had cash flow issues. So they didn't have a diversified pool of clients that they could pull from. It's kind of like all their eggs are in the proverbial one basket. Issue number 3 that we were talking about was the FDIC insurance. Why this was an issue is Silicon Valley Bank only had about 10%, actually less than 10% of their deposits covered by FDIC insurance. If you compare that to other banks, the average bank has about 50% of their deposits are covered by FDIC insurance. What does this mean? Well, FDIC insurance is up to $250,000 on any given account. Well, if Silicon Valley, like a bank like Silicon Valley Bank, where they have a lot of clients who have high account balances, they had clients who had millions and millions of dollars in these accounts. So when this bank run started to happen, their clients aren't dumb. They know that they have more than what's covered by FDIC insurance. So they were doing everything they could to get that money out, which only was like throwing fuel on the fire when this bank run started to happen. So those are the three things that led to the collapse of Silicon Valley Bank. Let's go into the next three questions that we should be asking is, one, what is this going to mean for other small to mid-sized regional players in the banking industry? Two, what does it mean to large financial institutions? And three, how is it going to affect interest rates moving forward? So let's go into the first thing is, what does this mean for small to regional players in the banking industry? Well, the first thing is that regulations are going to get stricter. I don't see any way that they're not. The federal government is doing everything they can to keep this from spreading to other banks. One of the things they've done is they set up something called the Bank Term Funding Program, which is a program that now allows banks to take any treasuries or mortgage-backed securities they have and use those as collateral to borrow money for up to 1 year from the federal government, just to increase liquidity if they need it, versus having to sell those at a loss like what happened with Silicon Valley Bank. The thought behind this is if there are other institutions in a similar spot, they can use this program to raise the capital they need, buy themselves a year to figure out how they're going to get through it and hopefully avoid defaulting. The other thing that we're going to see, I believe, is that it's going to hurt small to mid-sized banks from a profitability standpoint. Because regulations are going to go up, most likely these small banks are going to have to keep more cash on hand, which is going to lower their overall profitability. It also is going to hurt them from the fact that there's probably going to be clients who are thinking about diversifying their deposits and where they're held. So instead of holding all their money at any one company, especially a smaller or mid-sized bank, they may start looking to their larger counterparts, just knowing that these large institutions have more stringent requirements that they're subject to. So I think it's going to hurt small to mid-sized banks. It's going to make it a little bit harder for them to maintain bigger accounts, maybe from corporations. The second question is, what about large banks? Well, large banks, honestly, probably aren't going to be affected that much. If anything, this may help large banks. Why is that? Well, large banks are already subject to more stringent regulatory requirements. They have to have more cash on hand. They have to go through more stress testing. They have all these different rules and regulations that smaller banks aren't subject to. For these large banks, it's already business as normal. If anything, they may be able to lean into this and say like, hey, we have to go through more regulations to make sure something like this doesn't happen to us. Why don't you come do business with us? So there's a good possibility it could actually help larger banks long term. Question number 3, what about interest rates now? And what does this mean with the Fed and what they're going to do with interest rates? There's a good chance that the Fed is not going to raise interest rates as planned. There was a 50 basis point interest rate increase on the on the docket, on the horizon. With what's going on, when we look at why the Fed raises interest rates, a lot of it is to make it more expensive to borrow money and slow the economy down. News like this will probably kind of do that job for them for a time. People are already a little bit nervous, probably going to back off on a few things, and it most likely will keep the Fed from raising interest rates here immediately. However, once we kind of move past this, the Fed, I believe, is going to continue to probably raise interest rates a few more times, for the simple reason that they've still got work to do to ensure that inflation is completely squashed and back to where they want to be. They really want to make sure that we're not getting back to those super high inflation periods that we had last year. So probably temporarily no rate increases, but I think we'll get back to that here in the near future. The last thing I'm going to cover is, what do you do with stuff like this? How do you avoid this type of risk? Because it's terrifying. Well, our firm, we do specific things. Other than exceptions for reasons that we just aren't able to, almost 100% of the client accounts that we set up, we use a private trust company for their accounts. We also make sure that these institutions that we're using as the custodians are what are known as Federal Savings Associations. All this means is there's more stringent requirements than what you'll find in a bank or in a brokerage account or a brokerage firm, excuse me. What these requirements mean is that, number one, the client's assets can only be held in the client's name. So we can't go out and hold the assets in what's known as street name. And why this is important is that when client assets are held in street name, the company that's holding them can use those assets as collateral. They can trade those assets as margin. They basically have those assets on their books to use for their institution to invest, to lend out, and to make money on. The problem with this is that if that financial institution ever gets into trouble and their creditors come and say they have a claim to the assets on their book, it's not just the it's not just the company's assets, but now it's also the client's assets that are subject to, to those claims. We want to avoid that. So we make sure that anything that we set up for clients, all the assets are purely only held in the client's name, and the institutions we're working with cannot lend those out on margin, can't use those assets as collateral. Basically, it's just adding additional layers of security for those clients. I would say if you're looking for something you could do to add additional levels of security to your accounts, look for something like that. Guys, if you have any questions at all, we are here to help. Hopefully this video brought some value and some clarity to this situation. If there's anything you'd like to talk about regarding financial planning, this situation, or just something else, we're all pretty cool people here at Link Financial Advisory. Really appreciate you guys watching this. Thank you so much. Please don't forget to hit that like button, subscribe button if you like content like this. Otherwise, guys, I'll catch you on the next video. God bless. Hope you're doing well. Thank you so much.